Good day, ladies and gentlemen. Welcome to my YouTube channel. Today, we're going to be covering the general deduction formula as well as specific deductions. At the end of this topic related to general and specific deductions, you should be able to identify amounts that are deductible in terms of the general deduction formula, apply the qualifying criteria to determine whether an amount is deductible from normal tax or not, discuss and apply the principles in professionally and well-structured written arguments based on given practical situations. And lastly, you should be able to discuss and apply the legal and general principles included in the specific deductions in practical case studies. So let's take a look at the income tax framework. We've got gross income as per Section 1 of the Income Tax Act. Less are exemptions, which are contained in Section 10, and that will give us income. So today we're going to be focusing on the part that is highlighted in red, and that is the deductions and allowances. So income less deductions and allowances equals to taxable income before the capital gains tax inclusion. And we add the taxable capital gains, and that will give us taxable income. And this is the part where we calculate normal tax using the tax tables. If the taxpayer is an individual, if the taxpayer is a company, we multiply the taxable income by 28%. And if the taxpayer is a natural person, we will deduct primary or secondary or tertiary rebates or a combination of the three, depending on the taxpayer's age. We also deduct Section 6A medical tax credit, Section 6B medical tax credit, prepaid taxes, provisional tax, as well as employees tax. And that, ladies and gentlemen, is how we calculate the normal tax payable or refundable from SARS, right? So, like already mentioned, today we're only going to be focusing on the part that is highlighted in red, the deductions and allowances. Taxpayers can claim deductions in terms of the general deduction formula if the expenses or losses are incurred in the ordinary course of business and in the production of income. Section 11A of the Income Tax Act states that for the purpose of determining the taxable income derived by any person from the carrying on of any trade, there shall be allowed as deductions from the income of such person so derived, expenditure and losses actually incurred in the production of income, provided such expenditure and losses are not of a capital nature. So in order for an amount to be deductible from your normal tax calculation or from your taxable income, this expenditure or loss has to be actually incurred in the production of income, and it must be non-capital in nature. So let's take a look at the tax cases. These tax cases play a very huge role because the Income Tax Act does not explicitly, define what exactly is meant by an expenditure or loss actually incurred in the production of income, right? So that's why we place reliance on the principles of the tax cases, and you will be examined on the principles of these tax cases. Now I'm going to start with Edgar Stores Limited versus CIR. CIR stands for Commissioner for Inland Revenue. The taxpayer in this case entered into several lease agreements for its business operations. The lease agreements provided for a monthly rental expense, which was payable on a monthly basis, as well as turnover-based rental, which was due at the end of each 12-month period. Now, I just want to mention that the tax year, or rather, the year of assessment of this company and the lease year was not the same, right? I'm not sure what the year of assessment of this company was, but I know that the year of assessment of the company and the lease year end were not the same. So the taxpayer recognized an expense for the basic rentals, right, as well as a genuine estimate of the turnover-based rentals. So what happened was the taxpayer treated the monthly rent expense as an expense by debiting the expense and crediting either bank or credit expense payable. What do you call that? Yeah, trade creditors or accounts payable, right? So yeah, the correct term there is accounts payable. So yeah, what happened was the taxpayer debited the monthly expense, the monthly rent expense, and debited bank or accounts payable. And the taxpayer then went on to debit the turnover-based rent and created a provision. So they credited a provision because at the end of the year of assessment, the company didn't really know how much the turnover would be, right? So therefore, what they did was to estimate the turnover-based rentals and created a provision for that. So that's what happened. Now, the issue was the company had to decide, the court had to decide whether the genuine estimate of the liability for turnover rental was deductible in terms of Section 11A of the Income Tax Act as having been actually incurred. So the issue here was that the court had to decide whether the provision for the turnover rental was deductible in terms of Section 11A, whether this provision was actually incurred. It was held that, and when I say it was held that, this was the decision of the court. It was held that the expenditure relating to the payment of turnover rental cannot be regarded as having been actually incurred in the current year, right? This was just a provision. It was not actually incurred. So therefore, the principle from this case is an expense is actually incurred once the event has taken place. It must be unconditional and not contingent in order to satisfy the general deduction formula criteria. So from this case, our takeaway from this case is that an expense is actually incurred once the event has taken place. So if this is an event that is yet to take place, if there's an element of uncertainty there about the timing or the amount, therefore we can't exactly say that this expense has been actually incurred, and therefore it would not be deductible in the current year in terms of the general deduction formula. Another case is this is an Afrikaans word. I'm not sure how to pronounce this, but yeah. So in this case, what happened was the taxpayer with a 31-year end paid bonuses to its employees on the 30th of September every year. So there's a 31 March year end, and this company paid bonuses on the 30th of each year, on condition that the employees were still employed as at 31 October. So now the year end is 31 March. Bonuses are paid on the 30th of September each year, on condition that the employees, were still employed as at 31 October. So on the 31st of March, the taxpayer wanted to claim an expense for the bonus payable on the 30th of September of the following period. So this 30th of September would fall into the following year of assessment. So this is what the company did. They debited the bonus expense or salaries and wages, and they credited a provision for the bonuses that are payable, right? The court had to decide whether the provision for the bonuses was an expense actually incurred during the year of assessment for the purpose of Section 11A. So this is a similar case, like the one that this is similar to the case that we've just done in the previous slide. So the court held that the legal obligation to pay the bonuses was subject to whether the employees would be in the taxpayer's employ on the 31st of October. This uncertain future event fell outside the taxpayer's year of assessment, right? Because the year of assessment ends on the 31st of March. And therefore, the provision for bonuses had not been actually incurred. The principle is, if the liability is conditional in any way, if the liability is conditional in any way or contingent upon a certain event, then there is no expenditure actually incurred. So these principles are very important because the bonus which the taxpayer would pay to the employees sounds like a genuine expense, right? But if you don't know these tax case principles, you may treat that as a deduction in the current year of assessment, whereas it can't be deductible if it's contingent upon a certain event taking place or if it is conditional in any way. The next element of the general deduction formula is these expenditures and losses that are actually incurred have to be in the production of income. Now, I'm going to make reference to the PE Electric Tramway Co. Limited versus CIR. This was in 1936, but this case is still very relevant to date. What happened was the taxpayer was a transport company, and one of the drivers unfortunately died in an accident. As a result, the company was compelled to pay compensation to the dependents of the deceased. The court had to decide whether the compensation and legal costs subsequently incurred by the taxpayer were deductible in terms of Section 11A. The court concluded that, or the court held that, an expenditure has to be closely connected with and a necessary concomitant of the income earning business activities to be allowed as a deduction. The legal costs incurred in resisting the claim for compensation had not been expended in an operation entered into to earn income and were therefore not allowed as a deduction. So basically, what happened was the company had to pay damages, and the company also incurred legal costs, in the process of resisting the claim for compensation, and then tried to claim that as a deduction. So therefore, the principle was we have to establish, for an expenditure to be deductible, there has to be a close connection, right? So there has to be a connection between the expense and the income earning operations, right? So establish the close connection test by determining whether the purpose of the expenditure is to produce income and whether the expenditure is so closely connected with the income earned that it may be regarded as part of the cost of performing it. So in a nutshell, if this expense is closely linked or is closely connected to the income earning activities, then that expense would be deductible in terms of the general deduction formula. But if this expense has nothing to do with the income earning operations or activities, therefore, such expenditure would not be deductible in terms of the general deduction formula. Next up, we have Joffee and Co. Pty Ltd versus CIR. This was in 1946. Still a very relevant case to date. The taxpayer company had been negligent in performance of its work and was required to pay damages to the relatives of a deceased workman who was killed when a tower collapsed on site. The commissioner disallowed the claim for compensation as well as the legal costs incurred in defending the action. So what happened was the company was negligent. As a result, a tower collapsed on site, and an employee unfortunately passed on. So the company tried to claim the compensation, the damages, and legal costs as a deduction, and the court disallowed those claims. So the issue was the issue that had to be decided was whether the compensation and legal costs paid were deductible in terms of Section 11A as being incurred in the production of income. So this is the issue that gave rise to this court case, basically. It was held that negligent construction was not a necessary concomitant of the trading operations of a reinforced concrete engineer. The principle thereof is compensation will not be allowed as a deduction if it was incurred as a result of negligence of the taxpayer. Negligence is not a necessary concomitant of the trading operations. So in your questions, when you come across discussion type questions, you don't really have to write facts, issue, held, principle, and etc. All that's required of you is to just mention the name of the case and the principle. That's all that's required from you. And then, of course, you have to apply the principle in the question. The last aspect of the gross income definition is this expenditure or loss actually incurred in the production of income must not be of a capital nature. I'm going to make reference to New State Areas Limited versus CIR. This was also in 1946. The municipality incurred a sewage system installation. The municipality incurred sewage system installation costs on behalf of the taxpayer, and the taxpayer then reimbursed the municipality in the form of 2 monthly payments. The court had to decide whether either or both of the installments payable to the municipality was capital in nature. It was held that the costs incurred for the sewage system that will become property of the taxpayer creates a structure and will therefore be capital in nature. And the costs related to items that will not become the property of the taxpayer does not create an enduring benefit and will merely be recurring normal business costs that are deductible. So in a nutshell, the costs incurred in creating a structure that will belong to the taxpayer will be capital in nature. And the costs incurred in your day-to-day activities, recurring normal business expenses will be deductible because they'll be revenue in nature. They don't create an enduring benefit. So the principle thereof is we must distinguish between the cost of the operation of the business, which is revenue in nature, and the cost of creating the income earning structure, which is capital in nature. We also have BPSA Pty Ltd versus CSARS. This was in 2007. The taxpayer obtained the non-exclusive right to use certain licensed products and marketing materials from its offshore holding company and paid an annual royalty to the holding company. So this company the taxpayer was probably like a subsidiary The court had to decide whether the royalty payment was deductible in terms of Section 11A of the Income Tax Act, that is, the general deduction formula. It was held that the expenditure in issue neither created nor preserved a capital asset in the hands of the taxpayer. Whilst not in itself conclusive, was indeed a consideration of considerable importance. So, in simple terms, when no new asset has been created for the enduring benefit of the taxpayer, the expenditure naturally tends to assume more of a revenue character. The principle thereof is that the royalty payments made in terms of license agreements are of a revenue nature and therefore deductible in terms of Section 11A because they don't create an enduring benefit. Let's take a look at the specific deductions. Guys, remember, this is just a summary. There's so many text cases that you can make reference to, so many principles to learn. So please check them out and make sure you understand all of those principles. Now, I want us to take a look at specific deductions. I've just touched on a few of them. Specific deductions or special deductions are referred to as specific or special because they are deductions of a capital in nature, and therefore Section 11A would not be applicable to them. Let's start with pre-trade expense. Expenditure and losses actually incurred before the commencement of and in the preparation of carrying on a trade is deductible in terms of Section 11, capital letter A. So I'll give an example of a pre-trade expense. So let's just say you wanna open a shop, right? You wanna open a shop, and you go ahead before operating the shop. You go ahead and pay rent. You pay rent in advance. You purchase some trading stock, and etc. So these are expenses and losses that are actually incurred prior to the commencement of trade or in the preparation of carrying on a trade. So therefore, they are deductible in terms of Section 11A as soon as trade commences. So if you have incurred these expenses in the month of May and you only start trading in August, that's when you get to deduct them. There's also legal expenses, and these are deductible in terms of Section 11C. Expenses incurred in the actual earning of income itself are revenue in nature and deductible in terms of Section 11C. If an enduring benefit is created, for example, a long-term structure, the legal expenses are capital in nature and not deductible. So can I just give you a little example there? If the company incurs legal expenses during the acquisition of a capital asset, this would be an expense which is incurred in the creation of an enduring benefit. I hope I'm making sense. So if an enduring benefit is created as a result of these legal costs, or rather, if these legal costs are incurred as a result of an enduring benefit which is created, therefore they would be capital in nature and not deductible. Then there's restraint of trade payments. Section 11CA allows for a deduction of restraint of trade payments made to natural persons, labor brokers, and personal service providers. The deduction of a restraint of trade payment will be, I think, the lower of the amount of the amount of the restraint of trade divided by 3, and the amount of the restraint of trade paid divided by the period of restraint. Yeah. Then there's leasehold improvements. Section 11G makes an allowance available for expenditure actually incurred by a taxpayer enforced by a leasehold agreement to undertake improvements on land or to buildings used or occupied for the production of income. So the most important thing about leasehold improvements is that there has to be an obligation, right? There has to be an obligation imposed on the lessee to effect improvements on this property. If there's no obligation in terms of the lease agreement, then the lessee cannot deduct this amount, and the lessor cannot be taxed on the value of the leasehold improvements. So there has to be an obligation imposed on the lessee to effect improvements on the property of the lessor, and therefore Section 11G will make an allowance. Section 11G provides an allowance for the lessee on the value of the improvements. Then there's bad debts. A deduction is allowed for any debt due to a taxpayer that became bad during the year of assessment. Very important. This deduction is only allowed if the amount was included in the taxpayer's gross income in the current or previous years of assessment. So this is in terms of Section 11I, right? So if this is bad debt as a result of trade debtors, that's deductible in terms of Section 11I. But if this is a bad debt, which results from a loan to an employer or a loan to a supplier, there's no amount which actually went into the taxpayer's gross income, right? And therefore that would not be deductible in terms of Section 11I. Only trade debt is deductible because what happens when you sell on credit is that you immediately recognize the income, right, at the earlier of receipt or accrual. So you recognize the income, and when they don't pay, that's when you get to claim a deduction in terms of Section 11I. Then there's doubtful debt, allowance for doubtful debt. Section 11J allows 2 different allowance options based on whether a taxpayer applied IFRS 9 to the debt in question for financial reporting purposes or not. So if IFRS 9 has been applied, then the deduction will be 40% of the lifetime expected credit loss plus 25% of the 12-month expected credit loss. Guys, this information will always be provided in your question. You'll always be told whether or not IFRS 9 has been applied, and you'll be given the lifetime expected credit loss. So you'll multiply that by 40% plus 25% of the 12-month expected credit loss. This information will be very explicit in your question. If IFRS 9 has not been applied, then you multiply 40% of 120 days and older trade debt plus 25% of 60 days and older trade debt. So the question will give you the trade debt and the number of days. And if this trade debt is older than 120 days, then you multiply that by 40%. If it is older than 60 days, then you multiply that by 25%, and that's how much you get to claim as a deduction in terms of Section 11J. Now let's take a look at the prohibited deductions in terms of Section 23, right? So an amount can satisfy all the requirements of the general deduction formula, but be prohibited in terms of Section 23. So I've just summarized a few. Please check them out because this is a summary, okay? Now I'm going to start with domestic or private expenditure in terms of Section 23B and M. Domestic or private expenditure, including the rent of, cost of repairs, or expenditure in connection with any premises not occupied for the purpose of trade, is not allowed as a deduction except for any part occupied for the purposes of trade. So basically, if there's any domestic or private expenditure in connection with any premises which is not occupied for the purposes of trade, such expenditure would not be deductible. It would be prohibited in terms of Section 23B and M. So you may get a question where a portion of the property is used for trade purposes and the other portion is not used for trade purposes. So if you come across a question like that, you'll use the floor area of the property to apportion the expenses between the portion relating to trade and the portion expended on the other part that's not occupied for trade purposes. I hope I'm making sense. Then there's recoverable expenses. These are prohibited in terms of Section 23C. Any loss or expenditure that is recoverable under any contract of insurance, guarantee, security, or indemnity is not allowed as a deduction. So I'll give an example there. If the company, if the assets catch a fire or something, the company can't claim that as a loss in terms of the general deduction formula if the insurance company will be indemnifying or paying back the company for the loss, right? So they can't claim that as a deduction because there is an indemnity there. The company will recover the expense. So you can't recover the expense and then claim it in terms of the general deduction formula. Then there's interest, penalties, and taxes. These are prohibited in terms of Section 23D. The deduction of any tax imposed under the Act or any interest or penalty imposed under any act administered by the Commissioner, for example, the VAT Act, is disallowed. So you can't claim the interest, the penalties, and taxes imposed by any act as a deduction because they are prohibited in terms of Section 23D. Then there's non-trade expenditure, which is prohibited in terms of Section 23G. Section 23G prohibits the deduction of any monies claimed as a deduction from income derived from trade to the extent to which such monies were not laid out or expended for the purposes of trade. So you can't claim an expense if it was not incurred for the purpose of trade. Then there's restraint of trade payments, prohibited in terms of Section 23L. Section 23L prohibits the deduction of restraint of trade payments except those allowable in terms of Section 11CA. This means that restraint of trade payments made to a company will not be deductible for tax purposes, right? So I want to go back to Section 11CA. Section 11CA allows for deduction for restraint of trade payments made to natural persons, labor brokers, and personal service providers. So Section 23L is saying if you are not, if the restraint of trade payment was not made to a natural person, a labor broker, or a personal service provider, then such restraint of trade payment is prohibited as a deduction in terms of Section 23L. Then there's Section 23O for unlawful activities. The deduction of expenditure incurred in respect of unlawful activities is prohibited. This is For example, this is bribes and fines. All of those are unlawful activities, right? So you can't bribe someone or, or pay a fine, and then try claim that as an expense incurred in the production of income. That's prohibited in terms of Section 23(0). So let's take a look at a quick question. I'm going to start with the required. Briefly discuss whether or not the expenses relating to the transactions above would be deductible by XYZ Pty Ltd during its 2021 year of assessment in terms of the general deduction formula. So XYZ Pty Ltd has concluded the following transactions during its 2021 year of assessment, and the company requires your advice on the correct tax treatment in terms of the Income Tax Act for each of the following transactions. So there's 2 transactions there. So let's take a look at them. In terms of a 15-year lease agreement that XYZ has with Storage Shop Pty Ltd, XYZ had to affect an extension of the warehouse it leases from SS. The contract stipulates that the cost of the extension must be 1.5 million, and the extension of the warehouse commenced on the 1st of August 2020 and was completed on the 20th of February 2021 at a cost of 1.8 million. So for the purpose of this question, let's assume that the year ends on the 28th of Feb 2021. All right, guys, I hope you're following. Number 2, XYZ's Director of Operations resigned effectively from the 31st of Jan 2021 to commence his own transport business. The company paid him a restraint of trade payment of 600,000 rand to prevent him from operating his business within a radius of 200 kilometers from XYZ's premises. The restraint of trade payment was valid for a period of 3 years. So how would you guys approach these questions? How are we going to treat this, these leasehold improvements? How much can the company deduct as, as a deduction for the leasehold improvement? And also, is there anything that the company can claim, in terms of the restraint of trade agreement? Sorry, in terms of the restraint of trade made to the Director of Operations. So yeah, drop your thoughts in the comment section. Let's talk about it. Let's chat about it. Let's interact. I love engaging with you guys. Otherwise, thank you guys for watching. Please don't forget to like, comment, and subscribe. It really, really means a lot to me. Thank you guys. Goodbye.